We're going to do an investment quick take. And the quick take is around what are some bond alternatives? You know, like, I don't want bonds in my portfolio. I'm hearing this a lot from people out there. And one of the things that they're concerned with is that Fed's going to raise interest rates. My bond prices will go down. I thought I'd step back a little and talk a little bit more about this, because bonds is just a category. There's so many different types of bonds. There's municipal bonds, there's commercial paper, there's mortgage-backed securities, there's foreign bonds, there's corporate bonds, there's bullet bonds, there's treasuries. So not all bonds act the same, right? So you probably want to have an identifier there and what type of bonds you're thinking about for your portfolio, and what you're comparing it against in terms of why they suck or what have you. But some bond alternatives. So I got 3 of them. A lot of individuals out there have taken on more risk, and they found bond-like instruments. So we look at real estate. So like REITs would be one of them. Obviously, you want to go something that is publicly traded, and you can derive a stream of income from some of the publicly traded REITs out there. Another one could be like utilities or high dividend paying stocks, and just, you know, judging the stream of income as an alternative to having a large bond position. Another thing, so that was first one. So equity-like investments that act like bonds. The second thing is that you can look at structured notes, and there are structured notes out there that are in the time frame of 3 to 7 years that provide limited downside protection, but give you a stream of income based off the performance of a basket of securities. A lot of times these basket of securities are stocks that you like. You know, like it could be a bunch of blue chip stocks, and based off their performance from one quarter to the next, you get a stream of income. If they go down negative, you get a buffer on that, and you basically don't get the full amount of income that you should have gotten, but you don't lose principal value. And at the end of the term, let's say 3-year or 5-year term, there's also some, you know, principal protection in some of these notes. So that would be the second thing that you know, we could probably look at. And the third thing is, just in this environment with low interest rates, annuities that provide a stream of income that are based off of actuarial rates may be a good alternative to for a portion of your bonds. Not all your bonds, just for a portion. You know, when we look at someone's position, what we want to kind of identify is what are their core essential expenses, and make sure at least, you know, 40% is covered from guaranteed sources, right? And if we're looking at that, you subtract Social Security, any other pensions they may have, and that gap, you know, that gap may be suitable for an annuity type stream of income. So not all bonds suck. You know, bonds play different roles in someone's portfolio, but there are other options.